Everyone is obsessed with the same thing. They are looking for the next Nvidia, the next AI breakout, or the next stock that is going to double in a week. And look, I get it. Tech is exciting, growth is exciting, but while everyone is chasing hype and stressing over volatility, there is a completely different group of investors quietly building wealth in the background. They do not check their portfolios every 5 minutes. They do not care if the market is red today because they are getting paid in cash every single quarter just for holding their shares. I am talking about dividend investing, but here's the problem. Most beginners get dividend investing completely wrong. They chase the wrong metrics, they fall into traps, and they end up losing money because they do not understand what actually matters. In this video, I'm going to break down the exact framework you need to start dividend investing correctly. We are going to cover what a dividend actually is, the 4 metrics you absolutely need to check, and whether you should buy single stocks or stick to ETFs. Welcome back to Rebuild Finance. On this channel, I document my journey to building a $1 million portfolio. If you want to learn how to find elite businesses and compound your wealth over time, make sure to subscribe. Let's look at what a dividend actually is. So, what is a dividend? Keep it simple. A dividend is just a slice of a company's profits paid directly to you, the shareholder. When a company makes money, it has 2 choices. It can reinvest that money back into the business to grow, like Amazon or Google do. Or if the company is already huge and stable, it can take some of that profit and give it back to the owners. And that is where the magic happens. Because a dividend is literal passive income. You do not have to sell a single share to get that cash. If you need money from a pure growth stock, you have to sell a piece of your asset. With a dividend stock, the business just wires you the money and you still own the exact same number of shares. But let me stop you right here. Dividends are not free money. On the day a dividend is paid, the stock price typically drops by the exact amount of the dividend. So you are not magically getting richer overnight. This is why you have to understand the concept of total return. Total return is the stock price appreciation plus the dividends you collect. If a stock pays you a 5% dividend, but the stock price crashes by 20%, you are still losing money. Dividends are a piece of the puzzle, but total return is the ultimate goal. So, how do you find the right dividend investment? There are 4 things that actually matter in my view. Ignore the noise and focus on these. Number 1, stability. A dividend is useless if it gets cut tomorrow. You want companies that have survived recessions, crashes, and inflation without stopping their payments. Look for companies known as dividend aristocrats. These are businesses that have not only paid, but increased their dividends for 25 consecutive years. Stability is your foundation. Number 2, the payout ratio. This is the metric beginners always ignore. The payout ratio tells you exactly how much of the company's profit is going out as dividends. If a company earns $1 and pays out 90 cents, that is a 90% payout ratio. That is dangerous. Think of the payout ratio exactly like your own personal budget. If you make $5,000 a month and your living expenses are $4,800, you have a 96% payout ratio. One emergency, one car repair, and you are completely broke. A company is no different. If they are paying out 90% of their earnings, they have absolutely no safety net. When a recession hits or their profits drop even a little bit, that dividend is getting slashed. You generally want to see a payout ratio below 60%. It shows a dividend is safe and the company still has cash to reinvest and grow. Number 3, growth. Listen to me carefully on this one. Do not chase high yield. When a beginner sees a stock paying a 10% dividend, they think they found a gold mine. The reality is that in the stock market, a massive yield is usually a giant red flag. Let me explain exactly how a dividend trap works mathematically. The yield is calculated by dividing the annual dividend by the stock price. Imagine a stock is trading at $100 and pays a $10 dividend. That is a 10% yield. Suddenly, their earnings collapse, their market share shrinks, and Wall Street panics. The stock crashes from $100 down to $50. If they haven't officially cut the dividend yet, the yield now automatically looks like it is 20%. A beginner sees a 20% yield and thinks it is the opportunity of a lifetime, but they're stepping into a burning building. You are not locking in 20%, you are catching a falling knife. Instead of chasing a 9% yield from a dying company, you want a 2% or 3% yield from a strong company that is growing its dividend by 10% every single year. Dividend growth beats high yield every time. It is how your passive income outpaces inflation. Number 4, business quality. A dividend is just a byproduct of a business. If the business is weak, the dividend will eventually come under pressure. You have to look past the yield and look at the free cash flow. Free cash flow is the absolute lifeblood of a dividend. If a company doesn't have cash left over after running the business, they are either going into debt to pay you or they are about to cut the dividend entirely. Do not buy a bad business just because it pays you a dividend. Buy a great business that happens to pay a dividend. Total return first, income second. Now, if you are a beginner watching this, you might be thinking, this sounds great, but how do I actually start? Should I pick individual stocks or buy an ETF? Here's the reality. Picking individual dividend stocks requires real work. You have to read balance sheets, check payout ratios, and monitor the business every single quarter. If you pick the wrong stock and they cut the dividend, your passive income takes a massive hit. For 90% of beginners, a dividend ETF is a smarter play. An ETF, focusing on dividends, bundles dozens of high-quality dividend-paying companies into one single fund. You get instant diversification. If one company in the ETF cuts its dividend, you barely even notice because the other 99 companies are still paying you. There is an even bigger advantage: psychology. Let me be brutally honest. When a market crash happens, and it will, it is incredibly stressful to hold individual stocks if you don't know exactly what you're doing. You will see a stock down 30% and you will panic sell. When you own a broad dividend ETF, your psychology changes completely. You know you own a basket of the strongest cash flowing companies in the world. Instead of panicking, you look at that crash as a massive discount. You keep buying, and because prices are temporarily lower, you are actually locking in a higher dividend yield for your future. So, here's the framework. If you want to start dividend investing, focus on total return, not just the yield. Make sure the payout ratio is sustainable. Prioritize dividend growth over a flat high yield. And if you do not want to analyze balance sheets, use a high quality ETF to do the work for you. Dividend investing is not a get-rich-quick scheme. It is a slow, methodical process of buying cash-flowing assets that pay you more and more over time. It is how you buy back your freedom. And this is exactly the mindset I use as I continue building my own portfolio toward that $1 million goal. If you found this video useful and want similar investing content, hit that subscribe button to join Rebuild Finance. Now I want to hear from you. Let me know in the comments. Do you own any dividend stocks right now, or are you 100% focused on growth? Thanks for watching, and I'll see you in the next one.